Morning and welcome to this webinar being run by AXTA in conjunction with our partners at Future of Finance and being sponsored by Percival Software. My name is Bruce Butterill. I'm the Executive Director of AXTA, and we're very pleased to be conducting this session for you today. I was looking at the list of registrants, and there's people from all the way across the globe, which is very exciting and encouraging. This is a very topical subject for our community. A couple of administrative items before we get started. If this is your first time connecting to an AXTA webinar over Zoom, please look at the bottom of your screen. You'll find an interpretation tab, which is a globe with interpretation under it. If you click on that tab, you have an option of listening to whatever language a speaker is speaking in, whether that be English or Spanish. The presentations this morning will be in English. You have an option of clicking on English, and in that case, if someone is speaking Spanish, you will hear the voice of the interpreters. And similarly, you can click on the Spanish option and listen to the interpreter's voice while the presentation is being given. Today's presentation will be entirely in English. We will be taking questions. You can enter a question through the chat or preferably through the Q&A tab at the bottom, either with your name or anonymously. And during the QA, if you wish to say something, raise your hand and we'll get you connected to the audio, okay? With that, I would like to introduce Chris Richardson. Chris is a longtime friend and partner of AXTA and is the CEO of Percival Software, a product used by a number of our clients and a number of our members. And looking at the registration list, a number of the markets that are connected here today. So Chris is just going to say a few opening remarks and then pass on to Dominic Hobson for the tokenization talk. Okay, Chris, over to you.
Thanks, Bruce. I just want, from Percival's side, to extend a warm welcome to you on what for us is a hideous-looking November evening. It's very rainy outside. Anyway, I'm really grateful for both of our partners, AXTA and the Future of Finance, in setting up and facilitating this webinar, which is about a very topical subject, tokenization of securities markets, and in particular today, about how it relates to CSDs and their operations. So I'm sure you don't want to see or hear much more from me. I'm going to hand over immediately to our host, Dominic Hobson from Future of Finance. Thank you all and welcome again.
Thank you, Chris. I'd like to echo Bruce's comments. We're very grateful to Percival, both AXTA and Future of Finance, for making today's discussion possible. 25 years ago, I was working in an industry that was about to be disrupted by a new technology. The industry was publishing, the technology was the internet. Our business consisted of writing journalism to fill the space between display advertisements in print magazines, which were then mailed out to people the advertisers wanted to reach. The internet first destroyed the distribution, that's the snail mailing we did. Then it destroyed the revenues, the advertising. Finally, it destroyed the product itself, journalism. It's now impossible to make a decent living in trade publishing. Now, that is a familiar story in technological capitalism, but it has a savage twist. We've all laughed, as you can see, at the Western Union executive who dismissed the telephone as having too many shortcomings to be seriously considered as a means of communication. We've laughed at the founder of IBM predicting a world market for maybe 5 computers. Or worst of all, we've shuddered at the board of Kodak, telling the in-house inventor of the digital camera to take that box away, go away. We never want to see you again, in case he wrecked the market for photograph albums. But I know from personal experience that it's entirely possible to know that your business faces an existential threat, to understand the nature of the threat, and yet to be virtually powerless to do anything about it. That is the sobering reality that faces the central securities depositories of the world today. Blockchain technology, or to be more specific, the tokenization technique derived from blockchain technology, is an existential threat to everything that CSDs do. Today, CSDs play a vital role at multiple points in the securities services value chain, and it really is a chain, a sequential process in which data is passed between each link in an extended order of intermediation. Each link in the chain depends for its progress on the data received from the previous link in the chain, and each link in the chain must reconcile its data bilaterally and sequentially with the data kept by the other links in the chain. Even simplified like this diagram, it is still a highly complicated, highly intermediated process in which the CSDs are densely involved at 5 crucial points. Issuance, that's safeguarding the integrity of the issue. Settlement, delivering securities against payment in central commercial bank money. Registration, keeping a record of who owns what. Custody, keeping securities in an electronic omnibus or beneficial owner account. And finally, asset servicing, providing news of corporate actions and delivering their value to investors. Now, tokenization replaces that chain with a network in which data is either shared simultaneously or it's shared so fast that it might as well be simultaneously. Tokenization threatens every basic function of a CSD. Issuance. Instead of issuing securities into a CSD, companies issue tokens into the digital wallets of investors, or indeed their custodians or other advisors. Trading. Instead of being listed and traded on a stock exchange through brokers, tokens are exchanged directly between the wallets of investors on a blockchain-based network. Settlement. Instead of being settled by delivery of securities against payment in central bank money, purchases are settled by delivery of security tokens against payment tokens between digital wallets. Registration. Instead of the CSD keeping a register of investors and updating it every time a trade is settled, every transaction is recorded on the blockchain-based ledger. Custody. Instead of securities being held in accounts at the CSD owned by investors or their custodian banking agents, tokens are held in these digital wallets controlled by investors that are either on or off the blockchain-based network. Finally, asset servicing. Instead of corporate actions notifications being issued by CSDs to custodian banks, investors issuing instructions to those custodian banks to pass on to issuers, smart contracts are built into the security tokens that pay entitlements automatically to owners recorded on the ledger of the blockchain-based network as soon as certain conditions for payment, such as the dividend payable per share and the payment date, are settled. Now, if this is what happens, the stock exchange that owns many of the people listening today must undergo a metamorphosis into a tokenization platform or die. It also means that your role in issuance is gone, your role in registration is gone, your role in settlement is gone, your role in custody is gone, and your role in asset servicing is gone. And those things are gone because tokenization is not just a merely disruptive technology. It's not one of those modest changes that allow you to cut your costs or reduce your risks. It is a potentially comprehensive shift in the foundations on which the entire securities industry is built. That is why the wrong question to ask is, what does this tokenization mean for our business? The right question to ask is, what is the most efficient end state for the securities industry as a whole? And where precisely will we fit within it? Now, the good news is that a change in the underlying technology paradigm of an entire industry cannot happen overnight. The bad news is that you have absolutely no control over how fast that change will eventually occur. The rate at which tokenization is adopted is going to be driven by hundreds of minor advances in technology, thousands of decisions about costs, investment, and competition, and by millions of changes in the perceptions and the behavior of buyers of your services. And those are things over which you have no influence whatsoever. All you can know is this, that these changes are going to upset the existing structure of the industry, that they're going to overturn established competitive positions, and that somewhere in the turmoil created by these vast exogenous changes lie opportunities for CSDs as well as existential threats. And while those uncontrollable changes do their work, all you can hope to do is 3 things, each of which is much simpler for me to state than it is for you to execute. First, understand what is going on. Secondly, predict the likely evolution of the structure of the industry and the competitive landscape that results. Thirdly, throw as much resources as you can, by which I mean money and I mean people, at innovations you judge likely to endure and to create new, stable and defensible sources of revenue for the future. So our first problem is to understand what is going on. And this is hard because there is a lot going on and it's happening very fast. Frankly, it's impossible to keep up and still do your day job. You won't find it difficult to find people offering to do that work for you. But as leaders of the CSD industry, you must not let others dictate what you think. You must get into the details yourself, not try to rise above those details. You must shed the ingrained mental maps that have been built up over your career. You must ditch those routine corporate responses to any threat or any opportunity. Above all, you must look for data that can illuminate the terrain which is unfolding before you. Unfortunately, the data in this field is not of the best quality. There are multiple sources, they capture different sets of information, they contradict each other, double counting is absolutely rife, definitional problems abound, methodologies vary, like is not always being compared with like, and some of the data that would be very useful to analysts like ourselves doesn't even exist at all. However, there is one thing we can see very clearly indeed. Token markets can grow very rapidly. The market capitalization of cryptocurrencies has risen from 0 in 2013 to $2.5 trillion today, half of it attributable to Bitcoin alone and 2/3 of it to Bitcoin and Ether, just two of the coins. Coinbase, the leading centralized cryptocurrency exchange, was valued at $100 billion at its initial public offering in April this year. The amount of cryptocurrency held in decentralized finance protocols has risen from 0 in 2015 to nearly $90 billion today. And the market cap figure is put much higher, 175 billion, or even in one case at $260 billion. Uniswap, the leading DeFi token exchange, has a market value of over $13 billion. The value of non-fungible tokens, these unique digital assets I'm sure you've been reading about, that's increased from 0 in 2015 to $17 billion today. The main NFT marketplace, OpenSea, was valued in its most recent fundraising at $1.5 billion. Now, these markets don't operate to an 8-hour trading day. In fact, they never shut. They're open 24/7, 365 days a year. And they have grown astonishingly quickly without much institutional support and despite a string of thefts, of frauds, and of insider dealing scams. The main reason they have grown so quickly is they've cleared the major engineering hurdle by being 100% digital. Unlike most forms of engineering, software can be written, can be tested, can be fixed, can be upgraded very fast at very low cost. The time from concept to market as a result is vanishingly small. There is also intense competition to exploit not just opportunities, but vulnerabilities.
Alexa, set an alarm for 8 a.m.
Alarm set for 8 a.m.
So the infrastructures, as well as the products, evolve rapidly. The safe custody of private keys, for example, a topic of intense interest to CSDs, has passed from hot storage through cold storage to hardware wallets, and from multi-sig to multi-party computation. That's 3, if not 4, technological eras compacted into just a couple of years. In short, this wave of technology is driven by very young people writing code. Coding is the critical skill, which is why Glassdoor reports a 300% annual increase in blockchain-related jobs. It's why DevOps experts, the people who know how to deliver, evolve, and improve digital services at extremely high velocity, are the hardest employees of all to recruit. Now, CSDs are not well placed to attract DevOps engineers, but CSDs are well placed to understand what is going on. A lot of the output of the software being written will be extremely familiar to anyone working at a CSD. For all the jargon surrounding decentralized finance or DeFi, staking, yield farming, pooling, what is going on in DeFi is what has been going on in finance since the Sumerians invented finance 6,000 years ago as a means of transferring value through time. Lending, trading, asset management, insurance. It's market-based finance, that's all it is. As a CSD, you can be at home in this world if you make the effort to understand it, to engage with it, and to work out where you fit within it. Which brings me to the second problem, which tokenization sets for you. How will the industry and the competition evolve? At the moment, the security services industry is focused on custody, not of security tokens, but of cryptocurrencies. A number of custodian banks, especially in the United States, where the Office of the Comptroller of the Currency, the OCC, in July last year, allowed regulated banks to safekeep cryptocurrency. A lot of them now plan to, or indeed already offer, a service for cryptocurrency custody. There are also plenty of independent suppliers of custody services and of hardware and of software to safekeep cryptocurrency. This chart shows there's more than 50 of them, in fact. Cryptocurrency is also where private equity money is being invested. More money has been invested in cryptocurrency custody so far this year than in all the previous 6 years. Custody accounts for 1/4 of all private equity investment in all blockchain companies this year. Cryptocurrency exchanges offering custody and independent cryptocurrency custodians make up nearly half the blockchain unicorns to have been born in financial services so far, a unicorn being a company valued at its latest funding at more than $1 billion US. Now, why, you might ask, is cryptocurrency so hot? The answer is very simple. Institutional investors are buying cryptocurrencies. A survey conducted by ISA this year of asset managers and asset owners found 1 in 7 was investing in asset-backed or native security tokens already, and up to 2 in 5 expected to do so within 2 years. The cryptocurrency is not the real opportunity. Tokenization is. The combined value of 8 tokenizable asset classes. We need the next slide, please, Viviana. The combined value of 8 tokenizable asset classes, that's equities, bonds, real estate, mutual funds, privately managed assets, including privately placed equity and debt, and just one precious metal, that's gold, is $416 trillion US. That's 166 times the value of the entire cryptocurrency universe. If just 0.75% of global real estate or 2% of the global bond markets were tokenized, they would be as big as the entire global cryptocurrency market today. And this is starting to happen. Commercial real estate is being tokenized. Bonds are being tokenized. Collateral too, equities being issued in tokenized form. So are precious metals, fine art, private equity, mutual funds, and collectibles. Some of the largest asset managers in the world are funding the development of platforms to tokenize mutual funds in both London and Luxembourg. At a time when the core revenue source of the CSDs, namely publicly listed companies, is shrinking, tokenization is an opportunity which is very hard to ignore. And organizations just like yours are not ignoring it. The ISA survey of custodian banks and exchanges, which I referred to earlier, encompassed their sell and buy side clients. It found the numbers exploring blockchain had tripled in the last year. The number with live services had doubled. The value of the investments was up by 1/3. What were their biggest areas of interest? Bonds, ETFs, OTC equities, and mutual funds. The capabilities most affected: issuance, asset servicing, execution and settlement, collateral management. This is happening. It's happening to things that you do, and there are real reasons why it's happening. Tokenization cuts the cost of capital for issuers. It cuts the cost of transactions for investors. It broadens the range of asset classes that investors can buy, and it extends the number of investors that can take place in the market. For now, it remains laughably small, though the data available again is less than ideal. But after sifting through 3 lists of tokenized offerings, I identified a total of 134 unique security token offerings in the last 4 years, raising a total of around $10.3 billion US. Now that's less than 1/1000th of the size of the current global equity markets. But one thing, as I said earlier, we've learned from the cryptocurrency markets is these markets can grow very fast. And 2 of the major obstacles to the growth of security tokens are now being cleared. First, stablecoins have put the cash leg of token transactions onto blockchain networks. Very soon, central bank digital currencies will put central bank money onto blockchain networks. Secondly, regulatory uncertainty is dissipating. Generally speaking, security tokens are securities, and existing securities laws apply. Law and regulation, in other words, is no barrier to tokenization. Questions of speed and of scalability do remain unanswered, and the solutions advanced so far closed or permission networks, proof of stake rather than proof of work, sharding, nested blockchains, side chains, and so on. These techniques are not adequate to realize the full potential of tokenization on blockchain networks. Another problem to be solved is interoperability. Blockchain protocols themselves are diverging, and they need tools to allow assets to move between them. And just such tools like FinP2P are being developed now. Interoperability with traditional securities markets is going to be needed too, and it's going to be needed for a long time because tokens are not going to replace existing security markets overnight either. Ways for buy-side firms to trade seamlessly across tokenized and traditional markets must be found, and they will be, because we can see the new world converging with the old. Blockchain networks with securities markets, closed permissioned blockchains with open unpermissioned blockchains, unregulated firms with regulated firms. Across the world, on average, 76% of blockchain companies already have a regulatory license of some sort. This is not the Wild West anymore. Fanatical libertarian blockchain enthusiasts may still despise regulation, but blockchain-based companies are actively seeking regulatory licenses. In other words, being regulated already as you are provides no defense against disintermediation. You cannot hide behind your regulator. Your regulator, in fact, is out there already, ushering your future competitors within the same regulatory perimeter as you. In the future, what will eat the revenues of regulated incumbents is not unregulated challengers, but regulated challengers. Which brings me to the third and final challenge tokenization sets for CSDs. What innovations can CSDs adopt that will create new sources of revenue? As far as I can tell, most CSDs have yet to engage seriously with this question at all. A NASDAQ survey of market infrastructure CIOs in June this year found blockchain ranked in their list of priorities way behind AI, robotic process automation, and the cloud. 2/3 to 3/4 were doing nothing at all about blockchain. Now, of course, some CSDs have done and are doing things. Most of the moves depicted here are tightly focused on narrow problems, such as managing shorter settlement timetables. The bolder moves are being driven not by CSDs alone, but by the exchanges that own CSDs. Now, that's not unhelpful. A substantial majority of the CSDs in the Americas are owned or part-owned by exchanges. There's also a long and growing list of things that CSDs could do with blockchain. Tokenize their issuance services, provide digital wallets, governance, KYC checks, digital identities, validation, tax reporting, netting, standards, auctioneering, building a blockchain, taking on new asset classes. But some reticence about doing any of these things is understandable. The experience of ASX, a blockchain CSD project, has been delayed 3 times. And ID2S, a CSD startup, which had a discouraging experience, is discouraging for everybody. Most CSDs are also small. They don't have the people or the money to throw at speculative blockchain projects. Most CSDs are also incumbents. The instinct to resist threats to skills acquired over a long period and valuable positions occupied for many years is perfectly natural. Inertia, or an unwillingness or an inability to adapt to changed circumstances, is the default position of incumbents everywhere. To which monopoly, and most CSDs do occupy monopoly positions, monopoly adds this special difficulty of having customers that are also, for the most part, inert. If customers are not defecting, that's only because they have nowhere else to go. It doesn't mean the threat doesn't exist or that you are not vulnerable to competitors who know their costs and can price their products accordingly, or above all, that your customers are actually satisfied with the service they're getting. At which point I'd like to leave you with this short clip from a webinar I moderated recently.
No volume, Dominic.
Dominic, we can't hear.
Yes, but Viviana needs to unmute herself, not me.
Do you think utilities still have a part to play in transforming this industry? Only if they transform themselves. And I'm starting to get worried about their positioning, to be honest. I mean, you look at Swift, you look at CLS, you look at DCC, Euroclear, all the utilities we've grown up with. I think they need to start to articulate their future position. This ship is about to leave the docks here, and they need to jump on board. So yes, of course, if they do enable our transformation, we will wholeheartedly embrace them. But we can't let them slow us down either.
So next slide, please, Viviana.
Only if they transform themselves. And I'm starting to get worried about their positioning, to be honest. I mean, you look at Swift, you look at CLS, you look at DCC, Euroclear, all the utilities we've grown up with. I think they need to start to articulate their future position. This ship is about to leave the docks here, and they need to jump on board. So yes, of course, if they do enable our transformation, we will wholeheartedly embrace them. But we can't let them slow us down either.
I won't make you listen to that again. But there you have it, from Nadine Shakar, Head of Digital Services at one of the biggest global custodian banks in the world. Transform yourselves, articulate your position, or risk being left behind. Now, I hope these opening remarks have been helpful to everybody listening. It's time now, as Bruce outlined at the outset, for our open discussion. To help facilitate that discussion, we're joined by two independent experts in the field of blockchain and securities. Andrea Tranquillini is an independent consultant and advisor to financial market infrastructures, planning their course towards the digitalization of the securities industry. He's something of an expert on CSDs, having only recently stepped down as CEO of ID2S, a Paris-based CSD for money market instruments, but also having worked at 4 other CSDs, Clearstream, Monte Titoli, Globe Settle, and VP Lux. Jack McDonald is CEO at Standard Custody and Trust Company, a Polysign subsidiary that provides institutional grade custody for digital assets. You might have noticed them on one of the earlier slides. Jack is a former president and CEO of the Conifer Group, the fund administration business acquired by the Carlyle Group back in 2015, which he joined after a career in asset management with Schroders and UBS. But this conversation should not just be between the 3 of us. This is your event rather than ours. It's organized by AXTA for your benefit, and all 3 of us would welcome your questions and your comments starting immediately. So do please make use of the Q&A and the chat to start asking questions and making comments right away. I'm not going to save them up to the end, but actually answer them as we go along. But just to get our discussion underway, I'd like to ask the $50,000 question, really, and I'll put this to you first, Andrea. Is tokenization an existential threat to CSDs? In other words, am I right or am I wrong to worry that their issuance, their settlement, their registration, their custody, and their asset servicing roles are, if not in the near future, in the medium to long term, are redundant in fully tokenized security markets?
Well, thank you. Good evening, good morning, good afternoon, depends on the location where you are, everyone. And thank you for the question. I think that in the short term, I don't think it is a threat. I don't think it is a threat because CSDs need to still make their mind up with respect to what the future will be. They need to address the need of their clients, and they need to react accordingly. I very much concur with what Nadine Shakar of State Street, with a long past in Bank of New York actually, made. The ship is leaving the dock. So time of reaction is there, because otherwise in the long run, change brought by the use of DLT and tokenization will change, will reshape the industry. Things will take time. There is a lot of things need to change. You express very clearly how the market infrastructure works today, which is very sequential. Blockchain, a new wave of spaghetti network, as we used to call it 20 years ago, 30 years ago, brought by DLT may change things because things may happen simultaneously. In the financial market can be the result of something completely new, where things happen simultaneously, where exchange and functions are operated by the same legal entity than a CCP, that function operated by a CCP, and so on. So blockchain DLT can be revolutionary, but not in the short term. It's a bit too early. People need to move anyway. They need to take a move. And no action will be suicidal anyway.
Jack, Jack, one of the other things I said was that it's going to take a while, but these industries are, the traditional industry and the blockchain-based tokenized world are kind of converging. So you may want to agree or disagree with Andrea's comments about whether this threat is real or not, but what's your instinct about what the timescale of this transition, this convergence, until we come out at the other end with a totally transformed capital raising market? You're on mute, Jack, so don't forget to unmute yourself.
Well, I was just going to thank you, first of all, for having me, and I thought your presentation was excellent, by the way.
Well, thanks for being with us.
Yeah, just to Andrea's point, my immediate reaction to your question was whether or not tokenization, et cetera, represented a existential threat to CSDs. I view it more as an opportunity. I think back to decentralization in the stock markets, where you could have argued that that was going to really fundamentally change and perhaps in a very disruptive way how stock markets worked, and we evolved, I think, fairly quickly and efficiently. And I think the whole issue around dematerialization, et cetera, represents an opportunity for CSDs. I've watched this digital asset industry evolve over time, and at Standard Custody, we preach evolution, not revolution. We're not the anarchists in wizard robes driving around trying to overthrow the government. Quite the contrary. We're trying to operate within the traditional capital market system. And I do think that it will take time. There are incumbents who have business models that are premised on the current and legacy framework. So they're going to be slow to change, but there's a healthy tension, because when large clients want to embrace and pull in the future, they're going to push their service providers to do that as well. We've gone through a recent fundraising round where we spoke to many of the large global custodial banks, and I'd make a couple observations. 3 or 5 years ago, there was a lot of skepticism around Bitcoin, DLT, et cetera. 3 years ago, it was blockchain, yes, Bitcoin, maybe. Now that's a truism. I think most organizations think blockchain, DLT, absolutely here to stay, and there is a place for digital assets. Cryptocurrencies, I would argue, is a microcosm or a subset of that, but the broader tokenization opportunity is real. And these organizations are just trying to wrap their head around what that means and how quickly their organizations can change. From a demand perspective, to your point or your question, the common refrain we got in terms of an interest in investing now was more of a learning mode, trying to understand what's going on. All these large organizations have digital asset SWAT teams in some form or another that are looking at it, and they're considering buy versus build to get into it, but they will move more quickly when their clients really push them into it. So I think it is going to take some time. Absolutely agree with Nadine and Andrea in terms of the ship has left the port here unquestionably, and we can talk a little bit later. We're doing a number of proof of concepts with large organizations, large global asset managers, as well as service providers, asset servicing firms, and the time is now to be investing in the space. So I think it's an opportunity that could become a threat if CSDs worldwide, ignore the transformation.
Yeah.
We've got an interesting question from Claudio Calderon here, which I'll ask in a minute. But just Jack, could I just pick up the point you make about the institutions, the buy side, if you like, driving the pace of adoption here? I was thinking about this. Some of those figures I gave in one of those slides about the size of the equity and bond markets. You've got 120 trillion in the global bond markets, 105 trillion in the equity markets, and 327 trillion in commercial real estate. So these institutions don't have to, increase their allocation much to tokenized assets before you get quite a significant change going on. 1 or 2% would make a big market.
Yeah, it's a absolutely monster TAM, or total addressable market. And I think what it really speaks to from both the buy and the sell side, but let's talk about the buy side for a moment, is ultimately when you think about the opportunity that DLT and digital assets represent, it's really about bringing greater liquidity and transparency to a universe of asset classes, broadly speaking. And if you can ease the friction that exists today for many asset classes, you invite a whole new segment of investors, namely individual retail investors. It really speaks to the democratization of finance. And I think the buy side is looking at that. As everyone's industry is getting more competitive, this really opens up a potential floodgate of new investors if it can be done in a thoughtful way. The other thing I would add is, thinking back to the conversation thus far this morning, I'd ask everyone to keep in the back of your mind this notion that DLT and blockchains really replace trust with truth. And the question is how institutions, buy or sell side, can migrate to that sort of ethos. I still think that institutions operate on a series of trust, and to really move a paradigm of the global capital markets to a completely trustless framework is a really big leap to take right now. So going back to the question, we can talk more about this. I think CSDs potentially could play a really vital role as a trusted independent counterparty there. I think there's just the opportunity for them to evolve the underpinnings of technology they embrace, et cetera, because ultimately the buy and sell side still operate on a framework that's premised on trust.
So what you're really saying is that no matter how quickly institutions start to allocate assets to tokens, they're still going to want that paraphernalia of CSDs and fund administrators and custodian banks. Somebody who's going to make them whole if something goes missing. They're going to need that for some time to come. So they're not going to be able to enjoy all the cost benefits immediately.
At least in the interim, right? I think it will be a transitional or evolutionary thing. The individual retail segment can look at the whole DeFi movement, which is a peer-to-peer network, essentially, where I do not need a trusted counterparty or an untrusted counterparty to sit in the middle between you and me lending you fiat, you lending me crypto, or whatever it is. So I think the retail segment of the investor universe is there, or going there more quickly. It stands to reason that institutions are going to be behind it. So I think there will be this multi-year evolution. I'm not sure whether or not 10 years from now, Fidelity or the Capital Group, or filling a large asset manager is trading with another without any counterparty in between. I don't have the ability to think that far out with any degree of certainty, but it's heading in that direction.
Well, at my age, we need things to happen quickly, otherwise I get to miss them. Andrea, perhaps you could give us some, and Jack has begun to touch on this, but Claudio Calderon's question, he says, considering that custody is included on DLT platforms holding tokens, what could be the added value that CSDs could give? So we're in a situation, in fact, where there's a custody boom going on the back of cryptocurrencies and increasingly tokens. All those custodian banks getting into it. There's 50 vendors engaged in the process, including Jack's business. Where do CSDs fit into the custody boom, if you like? I think that's what Claudia is asking, really.
Well, I think that by addressing the threat they are living in order to address new services, CSDs must ensure, first of all, distribution. An issuer is the decision maker if he wants to go for tokenized issuance or not. He is really the decision maker, and he does it on the basis of the fact he may have in front of himself a buy side which has an appetite for this type of assets. If you live in you're a participant of a CSD as an issuer, as an IPA, and you live in a small ecosystem where there isn't this type of appetite, then easily the CSD is at risk because the issuer will go somewhere else to issue, where he has a buy side that is interested, is attracted by this type of instrument, and where this buy side may have an efficient secondary market. So where the CSD can play a role there is in having an efficient ecosystem, so providing custody, but for the largest possible number of participants, the most diversified. If you have a number of participants which are local, that are not buying assets, or they are not diversifying their portfolio with type of assets which may have a different form than the traditional one, from paper-based dematerialized into the digital one, then you see that the CSD is facing the risk of disintermediation, because issuers, the more and more, will go somewhere else. Not the case if you are a local issuer with a local buyer, and then things will continue. That's where, in fact, the CSDs may face a risk, and where the custodians, you mentioned the custodial activity as a cornerstone, may have a huge role to play.
And just on that local client base, are SMEs, if you like, stocks maybe being traded OTC at the moment, are they a natural target? You know, so CSDs want to get ahead of this. Should they start chasing those small, medium-sized enterprises, the ones which may be slightly illiquid because they're not being traded on a major exchange? Is that a tokenization?
The point is the funding, right? So you need to ensure your funding, and who buys your asset need to ensure an efficient secondary market liquidity. So otherwise it doesn't buy. The bottom line is that one. So an SME that doesn't have an efficient buy side in front would go somewhere else.
Now, Antonio Blasquez has asked an interesting question. He says, on the same line as Claudio's question on value added by CSDs, would not interoperability be a key matter where a CSD can solve a market problem and remain in business? In other words, can CSDs play a role in enabling interoperability between blockchain networks, but also between blockchain networks and traditional exchanges? That means, I suppose, designing and then promoting data standards. Or maybe it means setting up a whole new utility in a market or series of markets, so that you can kind of translate from one protocol to another. Andrea, I'm sure you've got views on this, but Jack, do you see interoperability facilitating movement of assets between these different networks as being a key role for CSDs?
I think it's critical. We are building, we've got two sides of our business under the parent Polysign. We have standard custody and trust, the custody business that you referenced earlier, and we also have another business that is premised on providing a network of networks, an interoperable blockchain between different protocols, analog and digital, to ultimately provide for instant atomic settlement of cross-asset class transfers. And the interoperability of that is key, particularly given the global nature that is represented by digital assets and DLT. You know, for the first time, we really, and we're a ways away from there. Where I don't want to suggest that, you know, 2 years from now, assets will be trading completely cross-border between all the different CSDs and exchanges around the world. But it's certainly heading in that direction, and this underlying technology provides for a way to do that. So if I were running a CSD, I would be thinking about how I can broaden my strategic scope to allow for interoperability and breaking down the different barriers, structural barriers that exist between different markets. Clearly, the regulatory compliance considerations need to be addressed. It's going to take some time for there to be an agreement there, common standards set, et cetera. But here's a perfect example of where the technology is ahead of, and I think years ahead of, the actual practice that exists in capital markets today.
So, Andrea, you know, CSDs have been among the first, for example, to adopt the ISO 20082 standard, yet there are all sorts of local variations of it. It got so bad that Swift had to set up a sort of harmonization charter, get them to sign that, saying, well, actually, let's try and stick to one standard rather than writing our own versions of the standard. And it's like the old joke, you know, the great thing about standards, there's so many of them to choose from. And that's a real issue now, isn't it? Because you've not just got this traditional markets problems, but you've also now got different blockchain protocols. So what's your answer to Antonio's question, which is, can CSDs solve this?
Well, I think at ID2S, we had sort of identified a solution for that. So CSDs live out of several sources of revenues, several flows. And we had been able to link these type of different flows that we were ready to be fully digital by June 2022 through external API. The concern and the advantage, if you want, in Europe is that settlement, the rule for settlement are defined by the Euro system that says today only off-chain settlement is possible. So we needed to translate any digital issuance through an API into an electronic record for settlement in target use securities. So this was what IDWS was ready to make, to put live by June next year, before our shareholder decided to pull the plug. But this is the way to live with an harmonized protocol and diversified a mechanism. Of course, we are way far from an totally harmonized industry. We've gone to 3 different generations of 5 series of Swift messages for securities, so 777.5, 1522, 2022. So we are at the dawn of a journey for what concern the DLT. So the unhomogeneous protocols is the rule today, and we have to live with that. But through API that managed to create this interface and read the information as received from a digital platform, we were able to do to bring this instrument to life and to these volumes into target use securities. Or we would have been able to be correct.
And did you use artificial intelligence to try and read this unstructured data? People were sending you information in whatever format they chose, and you had to unscramble that and match it with.
Yeah, that was in the high-level business requirement of this API. This should have been part of the functioning of the API. So we never went there because the journey was stopped. But yes, that was basically the fundamentals. So the idea was to utilize AI to read and translate these protocols in something harmonized. Yeah.
Well, there's a conversation going on now about standardizing APIs, of course, and I haven't failed to notice the securities industry has made pretty clear it isn't going to move to ISO 20022. So CSDs at least don't face that problem in that form. Anyway, there's been another a question here which takes in a slightly different direction. It's about the opportunities which CSDs have, and the question is tokenization more about the real asset classes than traditional equity bond markets in the short term, and how likely is it these asset classes will result in new markets? In other words, do we expect tokenization to work first, as I think it appears to be doing, in real estate, privately managed assets, precious metals, fine art, collectibles, and so on? Jack, what's your view about that? Is that where you think it's going to start first?
I do, and I think it speaks to what I referenced earlier about some of the pain points that the lower hanging fruit, if you will, represent around transparency and liquidity. We have 3 different POCs going on right now with this settlement layer that we're building. One of them is to create a digital feeder fund into an open-ended institutional real estate fund that a large asset manager has. And the CEO of that organization wants to bring more products to, as he refers to them, the man and woman on the street who otherwise wouldn't be able to access this sort of real asset fund. But if you can bring a digital feeder represented in a token that would trade on exchanges, that would offer liquidity whenever there's a buyer for a seller, all of a sudden you've opened up a whole new opportunity set to individual investors. Another POC we have is around a very illiquid corporate bond that is going to be tokenized. We're doing that for another asset manager. And the third is a digital asset VC type fund that wants to tokenize their fund and have essentially LP interest traded in token form. Real estate often comes up because of the illiquid nature of it. It's beneficial not only to the buy side, but also to the sell side. I used to run a fund administrator. very cumbersome, non-scalable type assets to service. If you could envision a world where a real estate asset would trade daily on an exchange, or you could get a mark, no longer you're in a situation as a fund administrator where you're having to have independent valuation experts go out, value the property, reporting quarterly in arrears on a delayed basis by 1 or 2 months. It would just completely transform it. And so I think once those initiatives are made more common and the benefits seen, I think that will pave the way towards equity and credit to start to trade that way. But yes, the short answer is it will start first with real assets and other type of illiquid and non-transparent type of asset classes.
Back to your previous life in the asset management industry, one of the things I thought might be a big opportunity, I mentioned this in the presentation, is the mutual fund markets, not even the private equity or VC markets, because you can envisage a tokenized fund market occurring in which the value of the fund is there'll still be fund accountants cranking out net asset values. So it might end up a bit like the ETF market, in which you've got a NAV calculation, but you've also got a secondary market in which these things are being traded. So instead of redeeming it on a principal basis back to the fund manager, you actually sell it to somebody. Right. So you start to generate price information that way. And that strikes me as, and maybe even start to tokenize the underlying assets themselves, the securities which the fund holds, which would obviously be a tremendous advantage in ETFs where you're having to settle transactions with the underlying assets in the first place. So how I detect in London, at least, quite a serious, and in Luxembourg, quite a serious discussion now beginning about this. As I said, asset managers putting money into token projects here. Are you seeing something similar in the United States? Or is the NSCC going to dominate this forever?
Interestingly enough, our POCs that I referenced are all in Europe. One is in, actually 2 are in the UK and 1 is in Luxembourg. We just started talking to a asset manager last week about tokenizing their fund. It feels to me like Europe is ahead of the US, at least in the travels that we're going through. And I don't really know why that is. It might just be opportunistic, the people that we're speaking to, or if there's something more structural going on. As I mentioned earlier, I think there's going to be a lot of resistance by the incumbents. They don't want to be pronounced about resisting it. Everybody has to put on the facade, at least, whether it's true or not, of wanting to pull the future of finance forward. That was a plug for you, by the way, Dominic. But really, you know, it would be detrimental to one's brand to suggest that, you know, they don't need to evolve and that they don't see the digital asset ecosystem coming. But the reality is, friction within the legacy capital markets is advantageous for many, and so there will be this healthy tension there. But we are seeing more advancement outside of the US right now. Could be the regulatory framework that we have here vis-a-vis other regions, not quite sure.
Andrea, to the point that Jack has just made about, there's a point I made as well, as you said, about incumbents resisting change. So it's a very natural instinct to think that what you're doing is valuable, and you know, you've been at it a long time and you don't want to kiss goodbye to it. I felt exactly the same when publishing was being destroyed. But you know, CSDs are incumbents, they are often monopolies. Do they actually need to change their culture in order to get ahead of this potential threat? I'm not quite sure what I mean by a culture, but maybe a different.
First of all, you use the word monopoly, right? So the CSDs come from decades in which they have been acting as monopolists, and then since 2014, with the creation of CSDR and the single market, in principle, they compete on issuer and investor CSD activities. So this is true, but only partly true, because we know that there a number of issuance, a certain type of instrument are concentrated or remain concentrated into the ICSDs, like the Eurobonds, despite Euronext is trying now with the acquisition of 4 CSDs to use doubling as a listing place for issuance of Eurobonds in the 4 CSDs. So try to challenge this mechanism. But absolutely, the CSD must change what you call culture. Is going to be a bit traumatic because they have been conservative at the moment of the entrance of into force of CSDR. Now we speak about something else than the regulation. We speak about new asset classes. So, and then the market is there. So the most advanced will be able to attract the issuers and the buy side that will be interested in that portion of the industry that will evolve from a traditional, conventional, either physical or dematerialized into the digital. And this is what in a very competitive market makes the difference. If you're there, you ride a horse and you bring home, or you defend eventually issuance that will convert from a conventional model into a digital one. If you're not following, then that's where you're losing. I think CSDR created a first perception of competition by putting the rules, opening the borders for everyone, but is now that we compete on new asset classes that are evolutionary asset classes compared to the past, that things will change.
Well, one of the benefits of CSDR for incumbent CSDs in Europe, at least, is you have to use a CSD. So you've got these tokenization platforms starting, which find they have to use a CSD even though they don't need one. But that was the point I was trying to make about not, hiding behind your regulator. Sorry, Jack, go ahead.
I was just going to say that, the where we are right now, and I think it's predictable that we're in this interim phase where you've got a lot of advancement from, frankly, startup companies that have been able to create a digital asset ecosystem and an infrastructure that moves very efficiently. The reality is we're still held back by some of the legacy infrastructures you just suggest, where you have digital asset exchanges. I know one in the UK called Archax, the first listed or approved digital asset exchange, and we're working with them on some of these POCs, and yet they have to still get off the new highway at an off-ramp to go to the CSD, dematerialize, move back to analog, and then out of analog back to digital for us to continue down the highway. And I just saw a question from
Montes as a post-trader.
I was just going to say that the guys at Montes, I saw a question from Martin come up, are addressing this and building a digital CSD. I think fascinating work that they're doing. And I've really learned a lot about how they represent the future digital CSD. Not a small task to understand and to overcome. And I think they're doing great work there. And I think, we'll continue to see the innovation at those type of companies. And so if I was an incumbent CSD looking at the future, I would watch very closely what Montes and others are doing there.
Yeah.
Okay, Andrea, make your point, then we'll deal with Martin's question.
Sorry, I didn't read the question. So
no, I thought you were going to add a point to what Jack was saying.
Oh, yeah. Well, in fact, I think that what is important for all these newcomers is to understand what transition means, because building a portfolio of assets that ensure that you have a viable business for a CSD is a challenging exercise. So having an average assets under custody of, 300 billion to break even on an annual basis is an exercise that requires time and effort, a lot of funding. And you cannot do it by simply doing a few POCs or by centralizing few issuance. So one of my points that I shared with Archax and with others is that it's very risky to start exclusively a new digital CSD, because you will burn your funding before breaking even, and then most probably you need 5 years at least to break even exclusively on digital assets, knowing that you continue to invest in develop functionalities to extend your the number of asset classes and the processes that you want to offer through your digital CSD. So the chicken and egg is a situation of chicken and egg. So is digital issuance sufficient to allow you to break even in 5 years, not even 3, 5 years, or you need, and that's where the incumbent are have a situation of privilege. You need to combine these new asset classes with the existing one, because that's a bit of a barrier to entry, not having the critical mass. The fact that there are many POCs, but no significant continuous flow today, and there will not be in 6 months. So things will not change because CSDs wait to see issuers to be more bold, and the issuers want to be sure, and the investors want to be sure that they issue something which is distributed. And if it is distributed in a digital CSD that doesn't have an ecosystem, then that's where the whole machine stops.
Mm-hmm.
So
okay, it's a game
fully
of chicken.
digital is a
Yeah.
bit risky.
Mm-hmm. Well, let's deal with Martin Watkins' question here. This is an interesting one. What is the panel's view on morphing the demarcation lines between exchanges, venues, trading venues, and CSDs as digital securities are increasingly adopted? Now, a lot of the people listening today are working for CSDs which are actually owned by exchanges. Maybe exchanges get into not just, listing security tokens, but actually maybe they get into things like netting transactions and so on. The CSDs can start to expand into new roles, and Martin clearly sees this line could be blurred to address the very point you've raised, Andrea, which is actually just building a CSD on a standalone basis and hoping to profit from tokenization. You'll probably go run out of money before that works.
I can tell you what we did with ID2S. With ID2S, we had created. We had two companies. We had Now CP, which was a trading venue, which was fully based on traditional technology, and ID2S, which was partly based on blockchain and partly based on conventional technology. From a technological point of view, we could have built one single company. Everything was one single huge system, right? The barrier that we had was regulation. Regulation all today tells you that you need to have a trading venue, MiFID, Europe at least, CCP, EMIR, and a CSD, CSDR. So you need to have entities. Regulation is conceived exactly of what you said at the beginning, Dominic, for processes which are sequential. And then risks are separated depending on the process as they are occurring today. So blockchain can blur these boundaries to the point of of Martin, of course. The point is that how you address your governance, your risk management processes in a context in which one single legal entity combines three different functions. Would the regulator allow that? That's where you have an inhibitor, I believe.
Yeah, it's interesting because, and I agree with that, Andrea, that by isolating the different functions, one is able to address the risk in a more targeted way, right? The flip side of that is, right? Yeah, right. That's right. But the flip side of that, this daisy chain of sequential services that are each regulated, are also inefficient. I think they were highly efficient. They were best of breed, whatever it was, 20, 50 years ago. Today, though, if you could just flick a switch, Coinbase, let's just pick on Coinbase, essentially does all those things today. It's an exchange, it's a custodian, it's a settlement layer, it's a CSD, all wrapped in one. And that's a big threat to the regulators. They can't wrap their head around, not to mention that it's global.
I agree.
But the efficiency is there. And I would argue through smart contracts and other opportunities that DLT represents, we could certainly see a better future, much more efficient, much more frictionless, much more cost effective, all accruing to the benefit of the ultimate end investor, that may come to the detriment of some legacy service providers who love friction. Their business model is dependent upon it. The question is, how do we cross that bridge? what threats really exist, right? And so it's going to take some time. But to Martin's question, the lines can absolutely blur. And I go back to my.
I mean, it will not. Huh?
Yeah,
sorry, I was probably not clear. I mean that from a technological point of view, you can do everything. On the contrary, you can go well beyond the infrastructure as it is built today because of the existing regulation. You need to overcome the regulatory element because regulation is always behind technology.
No question.
We see that in the European Union. Things are possible, but regulation is not there. We have only 2 countries where a DLT system providing notary services, as the one we had, is recognized as equivalent to a book entry one. It's France, of course, and now recently Germany. But in no other European country you can have a system like the one we had providing notary as central maintenance because it's not recognized as such.
Right. And the question is the market broadly defined ready to replace trust with truth? If we want a trust-based system, that's going to require a lot of regulation to really bring that into fruition and maintenance of an ongoing state. And that's what we have today, right? We trust one another. We trust the counterparties that we work with. I spend every day, a large portion of my day talking to prospective clients. And one of the questions we always get for our custody business, well, how much insurance is there? And what happens if all my assets get stolen? And so I tell them we're heavily insured through Marsh McLennan, et cetera. But I said, by the way, how much insurance do you have at your fill in the blank investment bank or global custodian? Well, we have Civic Insurance. Of course you do. What's the limit on your account? It's $250,000. I said, do you knock on the door of Goldman Sachs or State Street every day and ask them what your insurance, parameters are, your limits? But there's this notion of trust that, and a trust that the government will back it, and a trust that the regulator is there that's going to protect my assets. And I think in many cases, it's well-placed trust. The system has worked efficiently up until now. By and large, investor protection has worked well. And so I understand the tension between the current system and how we morph to this trustless system. And we see what's happening in DeFi. But again, DeFi is largely peer-to-peer. It's individual to individual. We've got some, forward-leaning hedge funds, crypto native investors, et cetera, who are in the space. But the big institutions are not yet ready to migrate from a trusted ecosystem to a trustless, truth-based system. If you believe that the blockchain is an immutable source of truth, then you'd really, if you fully embrace that platform, that ecosystem, that ethos, you are effectively voting with your feet to say, I'm no longer relying upon the same trusted ecosystem that I've lived in up until now. And there will be, to Andrea's point, absolutely a lot of regulatory changes that must take place to migrate from one system to another. And that's going to take time and collaboration. When's the last time there were global collaboration around regulatory standards? Never.
Never. It's a paradox. But
we've had FATF and we've had the G30, I think, and it does happen, even if the standards aren't always adopted in quite the right way. Listening to you, let's move the conversation forward a little bit, which is that, Jack, you've been very clear that you think the answer to there is a real reason that functions are separate in traditional markets. The CSD is separate from the asset manager, is separate from the broker, is separate from the exchange, and so on. That's because of potential conflicts of interest which might arise between those groups. And for all the efficiency that an integrated model, centralized model like Coinbase brings, your answer to that really is that you have to replace trust, that fragmentation of the value chain, with truth, and that will be enough. But do we think that that regulators are buying that? My instinct is that they're certainly open to that possibility. There are new ways of dealing with investor protection and financial stability, which don't entail sticking with the system which you've got. Andrea, you've been speaking to regulators in Europe for a while, and I guess, Jack, you've spoken to quite a few in the United States. Do you get the feeling that they're getting the balance right between the need to innovate and the need to protect the system from bad actors and unforeseen accidents?
I think the intent and the commitment is absolutely there. I think it's still a learning process for everybody in the industry, not just the regulators, for everybody. I think the industry would benefit from greater regulatory clarity. And I think there is still a little too much resistance by the regulators to really lay out any guidance. And I understand why. These are big rocks to move, and there are potentially massive ramifications of letting down certain regulatory framework too quickly. But let me be clear, notwithstanding that I'm an advocate absolutely for replacing trust with truth, because there will be a lot of benefits that will accrue to all the different market participants. I ultimately, and what we're doing at Standard Custody, is trying to meet in the middle there. So we chose to be heavily regulated by the New York Department of Financial Services. We would like more regulatory clarity. We think it behooves organizations like ours to ultimately service individuals and institutions by being regulated. So I'm not advocating for global capital markets to be a regulation-free zone. I don't think that will work, because I think there's still an element of trust in regulatory bodies that will provide ultimately a better framework for people. But I think the regulators need to be willing to stick their neck out a little bit more and to evolve with the industry, because right now technology has been moving so far ahead of the regulatory guidance that we're getting into a potentially dangerous situation, I think. And that's a real challenge here. And it's a common refrain that we don't want the regulators to stifle innovation, and it feels to me like that's happening right now in the digital asset ecosystem. And one of my predictions for next year is that we'll actually see some more regulatory clarity in the US, either from the SEC or the OCC, et cetera.
Andrea, what's the view from Europe, which our American friends could learn from, negative or positive?
No, but I think that the journey has been long since the Lisbon Agenda in 2000, and especially after the crash of Lehman in 2008. So many things have happened. We requested, as to the point of Jack, to have a market which is heavily regulated, or more regulated, let's say, maybe not heavily regulated, but more regulated. And as we said, it's inevitable that the regulator is a follower in the evolution of the financial market, because it brings the decision power but doesn't have the knowledge. That knowledge, which is blurred amongst ourselves sometimes. So establishing a new regulation for an evolving market is a difficult exercise. What I think is that, despite I have noticed the maximum collaboration, I mean, I said the French regulator in which we have been dealing with, or also the people at the ECB managing T2S, were extremely open and curious and interested about what we were doing. I think we need to live in Europe with the fact that hundreds of millions have been spent to create a single engine based on conventional technology, which is T2 and T2S. And then now the Euro system is working on a consolidation of T2 and T2S, which is again based on conventional technology. There is an attention on central bank digital currency. There is an attention on the use of blockchain. There is a digital package which is being approved by the European institution. There is now a trialogue for the MiCA and the DORA, and the DLT pilot regime is in advanced discussion too. But I think that the Euro system, the European Union, works on the basis of the fact that hundreds of millions be spent on establishing a unique, harmonized European infrastructure. They say they are technological, so if it works at the moment, they're not particularly in a rush in adopting DLT. It's easier, in my view, well, it's a paradox, in the UK, which has taken the good of the regulation, so is disciplined under CSDR, but a single regulator and not 27 need to deal with the financial market evolution. That's why I do believe that if there will be opportunities, they will be in the UK in the short term.
Now we're into our last 7 minutes or so. and we need to stop on time. So I'd like to just put to each of you the before we wrap up the challenge I set in my presentation, which is that the thing to worry about is not what this is going to do to your business, but what's going to do to the marketplace as a whole. So you can ask yourself, where does my business fit into this? So what's your view? What's the efficient, let's call it the efficient securities market of the future? What's it going to look like, Jack, in your vision?
I think it's going to have a number of aspects that are interoperable. I think it's going to be global in nature. So there's underpinning that going to be an element of regulatory standardization and collaboration. I think it is going to be instant. I think it's going to be atomic. I remember when we in the US went from T+3 settlement to T+2 settlement, it was a standing ovation, like a breakthrough moment. The reality is we can provide instant settlement today. So I think there will be this notion of instant and atomic settlement, right? So it's a pass-fail. Either both sides of a transaction fail or they both pass. And the number of intermediaries that are required to process a trade will be fewer and leaner. But I think there's still going to be a role for the sell side, absolutely, to play. I don't think we'll end up in a completely peer-to-peer counterparty-free system, but it's going to look different. It's going to be more efficient, and the benefits will accrue to both the buy and the sell side. Investors, whether they're retail or institutional, and I think sell sides organizations, while leaner and smaller, can be every bit as profitable and efficient, but it's going to take some time.
No. Jack, before I let you go, there's a couple of other questions come in here. How does the financial business case look for the changes being discussed? Can DLT deliver cost efficiencies that rival transaction costs of high volume processes like DTCC? In other words, can we make this cheaper than DT settling, custodying transactions and DTC managers today? The other question is, to the extent that CSDs can make their infrastructure interoperable, the digital exchanges and CSDs, is it really necessary to specifically use DLT? International standards suggest strongly integration between systems should be based on standard messages. Can't digital exchanges and CSDs use 2082? And can 2082 be improved to support that? So 3 questions there for you. Will this be cheaper than what DTC does today? Do we have
Absolutely.
to use DLT?
Unquestionably.
Yeah, okay. And
cheaper, faster, more scalable, more transparent, like light year, like can't even compare.
Okay, so the business case is easy to make. What about having to use DLT, blockchain?
I don't know any better alternative, and I think it's universally, it's capable of doing everything on a global asset agnostic basis. It's immutable, it's transparent. So the answer is yes.
Speed and scalability problems are solved, are they?
They're getting better and better every day. Absolutely. You look at the difference between Bitcoin and XRP, for example, it's incomparable. And things that are Ethereum and Solana are doing, it will only continue to evolve. Yeah. Speed and scalability are more than heading in the right direction.
Last question: you're a fan of standards, international standards, to improve these data exchanges?
They'd be terrific. It's hard work to get there. But,
okay. So Andrea, Andrea, we've got to stop in a minute, I'm afraid, Jack, in a couple of minutes. Andrea, just last word from you. Is the business case unarguable? 1, do we have to use blockchain? 2, and are standards the answer? They are a large part of the answer.
I think the business case is there, and DLT, blockchain, I think there is no better answer at the moment, to the point of Jack. Absolutely. We proved that it is possible, and it was successful. Scalability is not an issue because we managed to process 100,000 transactions per second. So it was good. I would add a couple of adjectives to what Jack mentioned being the potential market of the future. I would say horizontal, because the verticality of the silo as we know it today probably will be dismantled by the fact that technology allows different type of processing through smart contracts. And I would definitely say interoperable, in the sense that DLT will speak, and as it does already, with different technologies today. And there will not be a revolution into a full DLT financial market infrastructure in the future, despite what Percival may like or may want. But I think we need to live with interoperability, with a new generation of API that technology need to speak with each other. And possibly, and probably, market will be instant, but there will be a two-speed. Global players and local players.
Thanks, Andrea. We must stop there, sadly. I'm going to hand over to Javier Jara, who wants to say a word before we close off. Over to you, Javier.
Okay, thank you very much. As AXA chairman, I would like to thank to Jack, to Andrea, Chris, and particularly to Dominic for all your support to this event. For our participant, it's very, very important this kind of discussion, and also not just because it could be our survival as an industry, because of course we have to deal with the new challenge and new target for the future of our company. So honestly, thank you very much for your time to participate in this event. To Dominic, to trust in AXA again in order to organize this webinar. I'm going to switch to Spanish, so sorry for 1 second. Quisiera darle las gracias a todos nuestros miembros por participar el día de hoy. Creo que ha sido un evento increíble. La participación también ha sido gigante, así es que agradecerles a todos por participar, a Viviana y a Bruce por la colaboración en términos de organizar este evento, y por supuesto tenemos también un roadmap de nuevos webinars que esperamos contribuyan al fortalecimiento del conocimiento, que es uno de los objetivos que tiene AXA puestos en esta forma de poder interactuar a través de estos medios. Así que a todos un abrazo, gracias nuevamente. And back to you, Dominic, to make the closing. I say just to thank to all our members to participate in this event. So if you want to make the closing, or Bruce, the floor is yours again.
Javier, I just wanted to make a comment maybe for version 2 of this. I think it would be, I was very interested in what Jack and Andrea and Dominic had to say. I think it would be equally interesting to have another discussion along this line, but maybe have a couple of panelists that were thinking in a different direction in terms of what the market looks like. To have a little friction in the discussion might make for an interesting dynamic, because obviously not everyone is on board, or not everyone has drunk the Kool-Aid, as they say. It's going to take some convincing and a lot of discussion around how long this evolution or revolution is going to take. And I think ASC's false starts in this world have caused a lot of people to sort of back off and be looking from the sidelines at the moment to see how things emerge. But I think a follow-up discussion would be really interesting, and bring a couple of people into the discussion that maybe don't share or have views that are exactly aligned with those of Jack and Andrea. But really interesting discussion. Much appreciated. Thank you very much. Dominic, you get the final word here.
Well, thank you, Javier. Thank you, Bruce, for inviting us to talk to you today. Thank you to Chris for making it possible for us to do that, to invest the time. A big thanks to Jack for turning up on Thanksgiving, after all, very early in the morning there in California. Really appreciate that, Jack. And thank you, Andrea. I think you find yourself in a very interesting role, helping CSDs of the world to come to terms with what's happening on the basis of your experience. So, and thank you also to the audience for listening and for your questions. And if we can help again in the future, I'd be delighted to do so. But thank you and goodbye.